Hello, everyone, and welcome to the workshop Small Business Taxes 101. My name is Nelson Pizarro, and I'll be your instructor for this session. First, I want to thank you for taking the time to learn about small business taxes, one of the most important but sometimes most confusing parts of running a successful business. I also want to apologize because I had originally committed to delivering this workshop in person. However, due to a change in my schedule, I needed to be proactive and adjust the format. Instead of meeting in person, this workshop will now be delivered as a single video that we'll use during our 2-hour session. Throughout the video, you'll see slides prompting you to pause and discuss the content with all participants. These discussions are an essential part of the learning experience, so please take the time to share your thoughts and insights before continuing. I'm confident that this format will still give you everything you need, and maybe even make it easier to absorb the information and revisit it later. Let's get started. As you can see, we'll be covering 10 key topics, everything from understanding the tax landscape to identifying common mistakes and exploring useful resources. This workshop is presented as one complete video divided into clear sections. Each section focuses on a different part of small business taxation, starting with the basics and moving step by step through deductions, sales taxes, payroll, estimated payments, and more. Throughout the video, you'll see slides where you'll be asked to pause and discuss key concepts with the group. These reflection moments are designed to help you connect the information to your own business experience. So follow along, take notes, and participate in the discussion prompts as they appear. By the end of this session, you'll have a stronger understanding of how to manage your business taxes with confidence. Before we dive in, I'd like to start with a quick reflection. Take a moment and think about this question. What's your number one tax headache? Is it bookkeeping, deductions, sales tax, IVU, payroll, or keeping up with filing deadlines? When the pause and discuss slide appears, pause the video now and take 2 minutes to share your answer with the group, aloud if you're in the room together or in the chat if you're meeting online. If you're watching individually, jot your answer in your notes. Think about which part of the tax process causes you the most confusion or frustration. Pause video now. Discuss for 2 minutes. Once everyone is shared, press play to resume, and we'll see how today's topics help make that headache a little lighter. All right, now that you've had a chance to think about your number one tax headache, let's start by looking at the big picture of how small business taxes work here in St. Thomas, US, Virgin Islands, and Puerto Rico. Understanding who taxes what is the foundation for everything else we'll cover in this workshop. We'll start with the federal layer, which is managed by the IRS. Most small business owners in the Virgin Islands and Puerto Rico don't file directly with the IRS unless they have income that comes from U.S. sources outside the territory. Then we have the territorial layer, which is where most of your local obligations live in the U.S. Virgin Islands, that's the VBIR, the Virgin Islands Bureau of Internal Revenue. In Puerto Rico, it's the Departamento de Hacienda. Finally, think of taxes as falling into 3 main buckets. Income taxes, sales or gross receipts taxes, that's IVU in Puerto Rico and GRT in the Virgin Islands, and payroll taxes. As we go through the workshop, you'll see how each of these layers and buckets connects to the day-to-day reality of running your business. Now that we've seen the big picture of how taxes are structured in the US, Virgin Islands, and Puerto Rico, let's look at how your business structure or entity type affects your taxes. The type of entity you choose determines how you're taxed, what forms you file, and how much legal protection you have as a business owner. Let's start with the simplest option, the sole proprietor. This is the easiest way to start a business in both USVI and Puerto Rico. It's low cost and simple to manage, but the owner and the business are legally the same, meaning you personally take on all the risk and liability. Next, we have the limited liability company, or LLC. An LLC gives you that important layer of liability protection while keeping things flexible for taxes. In both territories, you can usually choose to be taxed either as a sole proprietor, a partnership, or a corporation, depending on your situation. Then there's the corporation, which is treated as a separate legal entity. This setup provides strong protection for the owners, but it also means more formalities and sometimes higher administrative costs. Finally, in Puerto Rico, there's a special type of structure called the Corporación de Individuo. It's designed for one-person businesses and offers the simplicity of a sole proprietorship with the tax benefits of a pass-through entity, meaning the profits pass directly to you as the owner without being taxed twice. Each of these structures has different tax and compliance responsibilities, so choosing the right one depends on your goals, your risk level, and how you want your business income to be taxed. In the next slide, we'll look at what good record keeping looks like, because no matter which entity you choose, your records are the foundation of staying compliant. No matter what type of business entity you choose, good record keeping is what keeps you safe, especially if you ever face an audit. Think of your records as your business's paper trail, proof that your income and expenses are legitimate. Here are the essentials. First, always keep a separate business bank account. This is one of the most important habits you can build. Mixing business and personal money makes it almost impossible to track your expenses, and it raises red flags if you're ever audited. Second, keep your receipts and keep them for the right amount of time. In the US, Virgin Islands, you're required to keep records for at least 5 years. In Puerto Rico, it's 6 years. Those receipts are your evidence. They show that your expenses were real and connected to your business. Next, categorize your expenses weekly. Don't wait until tax season. Just 10 to 15 minutes a week keeps your books clean and accurate. Then reconcile your accounts monthly. That means comparing your records with your bank statements to make sure everything matches. And finally, keep a cloud backup. Store your records digitally, either through accounting software or a secure drive, so if your paper files are lost or damaged, you're still protected. These 5 habits form the backbone of tax readiness. If you follow them, you'll not only make tax time easier, but you'll also feel confident that your business could survive an audit without fear. Now let's look at what this actually looks like in practice. Here you can see an example of a simple bookkeeping spreadsheet, something you can build in Excel or Google Sheets. Across the top, you'll see the main columns that keep your records organized. Date, when the transaction happened. Vendor or payee, who you paid, for example, Office Depot, Subway, or Facebook ads. Category, what type of expense it was, like office supplies, meals, utilities, or advertising. Payment method, how you paid, credit card, cash, or bank transfer. Amount, the total you spent. Business purpose or notes, a short explanation of why it was a business expense. And receipt, file name, or link to connect each record to its actual receipt. Each row represents one transaction. For example, on January 5th, there's a purchase from Office Depot for printer ink and paper, categorized as office supplies. On January 8th, there's a meal at Subway for a client meeting, categorized as meals, 50%, since meals are only partially deductible. This structure makes it easy to see where your money goes and ensures that every expense has documentation. Now that you've seen what a completed bookkeeping spreadsheet looks like, let's talk about how you can use this system for your own business. Start by creating a new Excel or Google Sheets file with the same columns we just reviewed. Each time you spend or earn money for your business, take a minute to record it. Include the date, the vendor, what it was for, and the amount. Try to do this at least once a week. It only takes a few minutes, but it saves you hours later when you need to prepare your taxes or apply for a loan. Make sure you categorize each expense correctly. That's what helps you track spending and identify tax deductions. Next, create a folder system to store your receipts digitally. For example, Business Records 2025-01 January receipts. Each receipt file should have a name that matches your spreadsheet entry, like 2025-0105 Office Depot supplies, $42.50. If you prefer, you can use accounting software such as Wave, QuickBooks, or Zoho Books. They automate much of this and let you attach digital receipts to each transaction. Finally, review your spreadsheet at the end of each month. Check that your bank statement matches your records and look for any missing receipts or duplicates. Keeping up with this simple routine gives you a clear picture of your finances and makes filing taxes in the US, Virgin Islands, or Puerto Rico much less stressful. Next, we'll move into one of the most common questions I get from small business owners: what counts as a deductible expense and what doesn't? Now that you've built a system to track your expenses, let's talk about what you can actually deduct on your taxes. The key rule is simple. Expenses must be ordinary and necessary for your business, meaning they're common in your field and helpful for running your operations. They don't have to be essential, but they must serve a clear business purpose. For example, if you're a baker, ingredients and packaging supplies qualify. If you're a consultant, your laptop and internet service do. But personal expenses, like vacations or new clothes, don't, even if you use them for work. Let's quickly review a few common deduction categories. Meals, you can usually deduct 50% when meeting clients or partners for business. Keep the receipt and note who you met with and why. Home office, deduct the portion of your home used exclusively and regularly for business. Documentation is key. Vehicle, deduct either standard mileage or actual expenses. Just track your business miles carefully. Education, training that improves skills in your current business is deductible. Switching careers is not. Travel, airfare, hotels, and transportation for business trips qualify. Only the business portion of mixed trips counts. Before moving on, here's a quick way to check yourself. Ask, would I have spent this money if I didn't have this business? If the answer is no, and it's documented, it's probably deductible. Pause video now, discuss. Take a few minutes to talk about which of these deductions apply to your business and any that you're unsure about. Once you've shared, resume the video to continue. To summarize, if an expense is ordinary, necessary, well documented, and clearly related to your business, it's likely deductible. Next, we'll look at specific taxes you may have to collect or pay, including sales tax, IVU, and the gross receipts tax in the Virgin Islands. All right, let's pause for a fun and practical activity, the receipt sorting game. You'll see 12 sample receipts. Your job is to sort each one into one of three categories: deductible maybe or not deductible. As you review them, think about what we just covered. Is this expense ordinary and necessary for your business? Does it have a clear business purpose? And do you have proof, like a dated receipt showing what it was for? If the answer is yes to all three, it's probably deductible. If you're unsure or it's partly personal, mark it maybe. And if it's clearly personal, like clothes or family meals, it's not deductible. Pause the video now. Take about 5 minutes to sort your receipts and discuss your choices with your group or partner. When you're done, resume the video to review the answers together. After participants unpause review section. Welcome back. Let's review a few examples. Office Depot for printer ink, deductible. Lunch with a client, deductible, but only 50%. New outfit for a meeting, not deductible. A training course, deductible if it improves your current business skills. A vacation where you checked email once, not deductible. Home internet, half business use, maybe only the business portion counts. The goal isn't to memorize every rule. It's to train your eye to spot what's business, what's personal, and what might need more documentation or advice. All right, great work. You've just practiced one of the most valuable tax skills a business owner can have. Now, let's shift gears and talk about something every business must deal with: collecting and paying taxes on your sales. Now that we've talked about what you can deduct, let's shift to another key part of small business taxes: the taxes you have to collect or pay on your sales. Many business owners get confused here because the rules differ between the US, Virgin Islands, and Puerto Rico. Let's break it down. In the US, Virgin Islands businesses pay a gross receipts tax, GRT, a 5% tax on total business receipts, meaning your total sales before expenses. Even if you didn't make a profit that month, you still owe GRT on the full amount collected. It's filed monthly using Form 720B through the Virgin Islands Bureau of Internal Revenue, VBIR, and filing on time is important to avoid penalties and interest. In Puerto Rico, instead of GRT, businesses deal with the IVU, Impuesto sobre Ventas y USO, or Sales and Use Tax. The total rate is 1.5%, which includes 10.5% for the state and 1% for the municipality. You collect IVU from customers on taxable goods or services, then send it to Hacienda through the SURI system at suri.hacienda.pr.gov. Registration: in both territories, you must register for a business tax ID before collecting or paying sales taxes. If you're unsure, check with VBIR or Hacienda. Record keeping: Keep all sales receipts, proof of IVU collection, exemption certificates, and reports from your point of sale system. These will support your filings if you're ever audited. Pause the video now. Take a moment to think about this question. Does your business sell products or services that might require you to collect IVU or pay GRT? If you're not sure, discuss it with your group or review your business transactions. When you're ready, press play to continue. Welcome back. Here's the big takeaway. In the Virgin Islands, you pay 5% gross receipts tax on total income, even without profit. In Puerto Rico, you collect 11.5% IVU from customers and send it to Hacienda. Both systems require registration, monthly filing, and good record keeping. Next, we'll talk about another area that often trips up small business owners, the difference between payroll employees and independent contractors, and what that means for your taxes. Now that we've covered taxes on your sales, let's talk about another big area for growing businesses, paying people. Whether you hire employees or independent contractors, you have tax responsibilities. The key is knowing the difference because misclassifying someone can lead to penalties and back taxes. Let's start with employees. If you have employees, you must register for payroll tax withholdings and file regular reports. You're responsible for withholding income tax, Social Security, and Medicare, then sending those payments to the correct agencies. In the U.S., Virgin Islands, you register with the VBIR and Department of Labor for payroll taxes, unemployment insurance, and wage reporting. In Puerto Rico, registration and filings go through Hacienda's USVI system, plus CNOT for disability and SUTA for unemployment. Each pay stub should clearly show deductions, and even if you use a payroll service, you are ultimately responsible. Now let's talk about independent contractors. You don't withhold taxes from their pay. Instead, you report payments at the end of the year. In the Virgin Islands, file Form 1099. In Puerto Rico, file Form 480.6. These are required if you paid $600 or more during the year. So how do you know the difference? If you control how, when, and where the person works, they're likely an employee. If they set their own schedule, use their own tools, and work for multiple clients, they're probably a contractor. When in doubt, check your local labor department's guidance or ask a payroll professional. Pause the video now. Think about who helps you in your business, maybe a bookkeeper, a cleaner, or a part-time assistant. Are they truly independent contractors or more like employees? Discuss your examples with your group, then resume the video when you're ready. Welcome back. Here's the key takeaway. Employees require registration, withholdings, and compliance with labor laws. Contractors require year-end reporting, Form 1099 in the USVI or Form 480.6 in Puerto Rico. Get these classifications right and you'll stay compliant and avoid costly mistakes. Next, we'll talk about managing your income taxes through estimated payments and set-asides, so you're never caught off guard at tax time. One of the biggest challenges for small business owners is managing cash flow for taxes. When you're self-employed, no one withholds taxes from your income. It's your job to plan ahead and make payments throughout the year. Let's start with the basics, estimated taxes. Instead of paying once a year, you make payments 4 times, on April 15th, June 15th, September 15th, and January 15th. In the U.S., Virgin Islands, payments go to VBIR, the Virgin Islands Bureau of Internal Revenue. In Puerto Rico, you pay through Hacienda's SURI system. So, how much should you set aside? A good rule of thumb is based on your net profit, your income minus expenses. In Puerto Rico, save about 25% to 30%. In the U.S., Virgin Islands save about 20% to 25%. For example, if your business earns $4,000 in profit, setting aside $1,000 prepares you for your next estimated payment. To stay consistent, automate it. Open a separate tax savings account and transfer a percentage every time you get paid. You can also mark those 4 payment dates on your calendar or set reminder alerts before each deadline. Pause the video now. Think about your average monthly profit and calculate what 25% would be. Write that number down. That's your monthly tax set-aside goal. When you're done, press play to continue. Welcome back. Here's the key takeaway. Estimated taxes are due quarterly, and setting aside 20–30% of your profit each month keeps you ready. Remember, automation beats memory every time. Next, we'll look at how to build your own tax calendar so you always know what's due, when, and where to file. One of the biggest challenges for small business owners is managing cash flow for taxes. When you're self employed, no one withholds taxes for you. It's your responsibility to plan ahead and make payments during the year. Let's start with estimated taxes. Instead of paying once a year, you make payments 4 times on April 15th, June 15th, September 15th, and January 15th. In the US, Virgin Islands, you pay through VBIR, the Virgin Islands Bureau of Internal Revenue. In Puerto Rico, payments go through Hacienda's SURI system. So, how much should you save? Use your net profit, income minus expenses, as your guide. In Puerto Rico, set aside 25-30%. In the Virgin Islands, set aside 20-25%. If your monthly profit is $4,000, saving $1,000 keeps you ready for your next tax payment. To stay consistent, automate it. Create a separate tax savings account and transfer money automatically whenever you get paid. Also, mark those 4 due dates on your calendar or set reminders a few weeks in advance. Pause the video now. Calculate what 25% of your average monthly profit would be. That's your monthly tax set-aside goal. When you're done, press play to continue. Welcome back. Here's the takeaway. Estimated taxes are due quarterly, and saving 20-30% of your profit each month will keep you ready. Automation, not memory, is what makes it work. Next, we'll build your tax calendar so you always know what's due, when, and where to file. Let's look at a quick case study to bring everything together. This is Island Goods Company, a small business that sells handmade products in St. Thomas and Puerto Rico. They make sales every month, both in person and online, and now need to figure out how to handle their taxes. Here's what we know. In the Virgin Islands, they file the 5% gross receipts tax each month using Form 720B. In Puerto Rico, they collect the 11.5% IVU and file it through SURI. And for income taxes, they set aside about 25% of their profit for quarterly estimated payments. Pause the video now. If Island Goods made $6,000 in profit this month, how much should they set aside for taxes? Think about it, about 25%. Write your answer down or discuss it with your group. When you're ready, press play to continue. Welcome back. If you said around $1,500, you're right. Setting that money aside keeps them ready for their next tax payment. This same system works for any small business, whether you sell online, offer services, or run a local shop. It's all about knowing which taxes apply, when to file, and how to plan ahead. Next, we'll talk about common mistakes small business owners make and how to avoid them. Before we wrap up, let's go over the top 10 mistakes that small business owners in the Virgin Islands and Puerto Rico often make when it comes to taxes, and how you can avoid them. Mistake #1, paying the wrong tax agency. If you're in the US, Virgin Islands, you pay the VBIR, not the IRS. Many new business owners accidentally send payments to the IRS, and that can delay refunds or create confusion. Mistake #2, missing IVU filings in Puerto Rico. Even if you didn't make many sales, you still have to file the report. Skipping a month can lead to penalties. Mistake #3, ignoring the gross receipts tax when you didn't make a profit. Remember, in the Virgin Islands, GRT is based on total receipts, not profit. You owe 5% even if business was slow. Mistake #4, misclassifying workers. We covered this earlier. Don't treat employees as contractors. It's one of the most common and expensive errors small businesses make. Mistake #5, mixing personal and business funds. Keep separate accounts. This one habit makes tax filing, bookkeeping, and audit so much easier. Mistake #6, not keeping receipts. If you can't prove it, you can't deduct it. Use digital copies, scan them, or store them in the cloud. Mistake #7, forgetting to renew your business license. Most territories require an annual renewal. A late renewal can mean fees or even a temporary suspension. Mistake #8, skipping estimated tax payments. If you wait until the end of the year, you could owe a large lump sum and face underpayment penalties. Mistake #9, using the wrong tax ID. Always check that your EIN or business ID is correct on all forms. It affects how payments and filings are matched. Mistake #10, waiting until year-end to do your books. Don't wait. Schedule a regular bookkeeping day each week or month. Even 30 minutes a week helps keep your business organized and tax ready. Pause for reflection. Go ahead and pause the video for a moment. Look at this list and think, which of these have you struggled with before? If you're watching this with others, share one or two mistakes you've made in the past and what you'll do differently this year. When you're done, press play. Welcome back. Here's the big takeaway. Staying organized, filing on time, and keeping clear records are your best tools for avoiding tax headaches. Next, we'll wrap up with a few key resources that can make managing your business taxes easier and help you get extra support when you need it. You've made it to the final step, putting everything we've learned into action. We've covered deductions, record keeping, payroll, and tax payments, but none of it matters unless you take the next step in your business. This slide is your personal action plan, 4 simple steps to get started right away. Step 1, pick a weekly bookkeeping time. Choose a consistent day, maybe Friday mornings or Sunday afternoons, and make it your money hour. Use that time to record income, review expenses, and update receipts. Consistency is key. Step 2, open a tax savings account. Move your tax set-aside money there automatically each week or month. It doesn't have to be fancy. Just keep it separate from your business funds. Step 3, add your tax deadlines to your calendar. Include your IVU or GRT filings, quarterly payments, and license renewals. Set reminders 1 week before and 1 day before each deadline. Step 4, schedule a quick tax consult. Meet with a tax preparer or advisor even once a year to confirm your setup and plan ahead confidently. Pause the video now. Write down your own action plan. Which of these 4 steps can you complete this week? If you're watching in a group, share your top priority. When you're ready, press play to continue. Welcome back. Here's the big takeaway. Small, consistent actions throughout the year save you time, stress, and money at tax time. Congratulations, you've completed the Small Business Taxes 101 workshop. I hope this gives you clarity, confidence, and control over your business finances. Thank you for watching, and I look forward to seeing how you put this into action. Before we finish, I want to leave you with a few key resources that will help you stay on top of your business taxes, whether you're operating in the US, Virgin Islands, or in Puerto Rico. For the US, Virgin Islands, you'll find everything you need at the Virgin Islands Bureau of Internal Revenue, or VBIR, at vbir.gov. That's where you can access forms, filing instructions, and payment portals for income tax, gross receipts tax, and business licenses. You can also visit the Department of Licensing and Consumer Affairs, or DLCA, at dlca.v.gov. This is where you handle business license applications and renewals. For Puerto Rico, the main system you'll use is Hacienda's Surrey portal at surrey.hacienda.pr.gov. That's where you'll file IVU, income taxes, and estimated payments. If you're starting or managing a business, check out the Single Business portal at sbp.pr.gov. It's a great one-stop site for permits, registration, and compliance updates. Pause for engagement. Go ahead and take a quick moment to pause this video. Visit 1 or 2 of these sites, even if it's just to bookmark them. Familiarizing yourself now will make tax time much smoother later. When you're ready, press play to finish. Resume, closing message. And that's it. You've completed Small Business Taxes 101, St. Thomas and Puerto Rico edition. You now know how to choose the right business structure, keep audit-proof records, manage payroll and contractors, stay on top of IVU or GRT filings, and plan ahead for taxes with confidence. Thank you for joining me in this workshop. I hope this gives you the tools to run your business smarter and with a lot less tax stress. Keep learning, stay organized, and remember, consistency is key. I'm Nelson Pizarro. Thanks again for watching, and I wish you continued success in your business journey.